Right, part 3 commences with doing transactions in the accounting equation format, which I can promise you is not the format we're going to emphasize in this class. The end. This is just a learning tool, so we're just going to step through it. It's a little bit more elaborate than the example that was in my handout, so that's the usefulness of it here, is it gives you more examples in that that format. But again, we're going to end up cleaving to a much better way of demonstrating day-to-day business transactions than this. So again, just a learning tool just to get you through the basic idea of how the accounting equation works. Right, so again, we're starting with again another startup business here. So we got Gordon Consultants Inc. This is going to be CGI accepts $100,000 cash plus an automobile with a fair market value of $25,000 from Barbara Gordon in exchange for 10,000 shares, common shares of CGI stocks. So again, how's that going to look in terms of the accounting equation format? Now, this is an example of a compound entry. Why? Because we're going to affect more than just two areas. More than two things will be impacted here. So this transaction looks like so. So in other words, the business now gained this much in cash, and also this much we'll put under the category of automobiles, which again, most of these categories should be fairly self-explanatory. I think I explained them again. Cash is self-explanatory. Accounts receivable, anytime we provide services for a customer who's going to pay later. Automobiles is just in this case, it's just an asset classification for assets that we use in the business. And then, of course, this also will be true for computers as well. All right, so we have more cash, more autos. And again, we're going to total those together, and that's going to be where we get the total impact on common stock. It's going to go up $125,000. Again, this is an investment transaction. An important point was, how did the automobiles come into the business? At fair market value, not what Barbara Gordon paid for them, but what they were worth at the time that they were donated, quote unquote, to the corporation. That's an important distinction to make there. Not with the out of pocket expense or cost was to the person dedicating it, but what it's worth at that moment. So that's where fair market value does come into play. So that was for A. Now B is going to be CGI pays rent for the current month, $2,000. And so for this one, because we're just paying for the current month, instead of put something in an asset category, it's acceptable to do the following. Just immediately book this, again, under the subheading of retained earnings. So it's a subtraction from retained earnings of $2,000, and also a subtraction from cash. Again, the brackets to demonstrate the negative a little easier in this format. And we will do away with that when we go to the general journal format that you'll see as part of the debits and credits series of handouts and also videos. So all that coinciding. Right, C. So CGI is going to buy computers for the staff, $10,000. Straightforward enough. So this is going to be an increase in computers, and of course a corresponding decrease in our cash account as well. Again, this balance row, I just put it there to say everything still balances out. Yeah, I don't really refer to it all that much. Just letting you know the accounting equation has not been violated. Again, that's one of the useful things you'll see about the other format I discussed in passing there, the general journal format, is that it does away with the worry of like, is the accounting equation still balanced? Yes, it does. If you follow this other rule, you don't have to worry about it here. Right, for D, and I'm not highlighting these, so just let you know where do we stand right now. We've gotten through these. We're on D right now. Completed consulting jobs for 3 clients who paid cash, $12,000. Now, I could have just said what? Completed consulting jobs for 3 clients, $12,000. Why is that enough? Well, it's implicit, right? If I don't say how they paid, with, again, if I didn't add, what's the magic phrase? I didn't say anything about on account or on credit. So if I just say we completed consulting jobs, $12,000, you have to treat it like you'll see over here. In other words, we know that that should be treated how? An increase in cash, $12,000, and of course, because we've earned the $12,000 in this case, provided a service, so fees earned should be increased likewise. And again, that will have a corresponding increase in retained earnings as well. All right, now E, completed consulting jobs for 5 clients who were billed, payment due in 30 days, $20,000. So again, this is another way to refer to on account or on credit. Instead of saying that phrase, sometimes it's a little more realistic to say, how do we know it's on account or on credit? We billed somebody, right? So that's an easier way of tackling that same concept. Oh, we billed them, therefore it's implicit that we're dealing with an AR in this case. So that's why you'll see it treated like so. So we should see an increase of AR of 20, and of course, once again, we earned the 20,000, so it should be referenced under fees earned as, again, one of those subcategories of retained earnings. That, again, will be broken out separately when we get to the debits and credits material. All right, F, purchased another automobile for staff, $5,000 down, balance of $25,000 on credit, due in 12 months. Not necessarily realistic in this case, but just a simplifying factor. We're going to throw too many accounts at you here in the early going. Another compound entry. So what happened here? So we know if we add up those two elements, what we're assuming in debt plus what we paid up in cash, that means that the impact on assets of the automobile should be $30,000. Should go up by 30 because that's what we ultimately paid. But again, what happened here? We surrendered $5,000 in cash, and liabilities went up by 25. So if you look at all that, all balances out. We get 25,000 on the asset side plus there, plus 25 on the liability and owner's equity side. So see, it all balances out. And now we got G here, paid staff wages for the month, 9,000. And this is how it's going to look until the very, very last thing we covered in the class when we'll talk about payroll. Again, more realistically, there's, you know, a bunch of things deducted from the gross amount we pay our employees. In this case, that would be referenced by the 9,000 in this case. And then, you know, minus all those things, usually those will show up as liabilities, and then the net amount after that equals how much we actually pay in cash. We will cover that eventually, just not at this juncture of the class. That'll be like one of the last things we talk about. So for now, it's just going to look like this. So we'll have what? We're surrendering 9,000 in cash, and as a consequence, we have wages expense equal to 9,000. The end. Those will just equal each other, and you're done. Nothing more than that. All right. H, collected partial payment from clients in E7500, or I could say collected cash on account or on credit. Would it get us to the same place? It means it should look like so. So we should see an increase in cash of 7,500, and we decrease the AR balance because they don't owe us that money anymore. Simple as that. So we're just exchanging one asset for another. In this case, actual payments with a promise of payment, which is ultimately what we want. I made partial payment on an automobile purchased in F, 5,000. So in this case, we're paying off part of that liability. So that will be demonstrated by doing what? Decreasing cash 5 and the liability account by 5 as well. Nothing more to that one. And then lastly, we're going to pay dividend of $3,000 to our sole shareholder, Barbara Gordon. So payment of dividends looks like expenses in terms of the impact on retained earnings. But again, remember when we went to the income statement, that was not true, right? We don't. Net income is measured as what? Earned revenues minus incurred expenses, and then dividends, we don't make an appearance until where? Till we're on the statement of retained earnings. So that's when you'll see them. So the transaction is decrease in cash, 3,000, and a decrease in retained earnings ultimately of 3,000 as well. And all we have down here is all our final balances for all our asset accounts. 85.5, 12.5 for AR, autos at 55, 10,000 computers. And that'll be equal to our $20,000 balance in AP plus our 125 in common stock. And again, if we net all of this here, this will be what the ending balance in retained earnings is, which I will tell you that it should be. This all nets to 18. Ooh, that is an 18, I swear. That's an 8 there, not a 3. 18K. That's what you get there. So our 125 plus our 18K plus our 20 equals everything on the asset side. So everything balances out here. So that's what you should get as your final numbers in this exercise in part 3 here. All right, that concludes part 3, because I'll continue this with part 4 in the next video. See you there.